Okay, afternoon, everyone. Thanks very much for joining us today, and welcome to the first feast of ideas for your ISA. So, as I'm sure you're all aware, we'll be doing an event every day or every working day this month at lunchtime. So each day we'll have a different manager talking about their fund and so on. And to get started, we're doing a fireside chat with Paul Niven. So Paul, I'm sure, will be familiar to many of you. He is the global head of asset allocation at the F&C Investment Trust. He's global head of asset allocation at Columbia Threadneedle and is the fund manager at F&C Investment Trust. The trust seeks to generate capital and income growth by investing in a global equity portfolio. It's also managed to deliver 51 consecutive years of dividend growth to shareholders. So I'm sure that's likely to appeal to many of you watching. So the idea here is we're just going to have a sort of back and forth, just about growth and income. That's the sort of topic. And then at the end, there'll be some time for Q&A. So please do submit questions if you have any. So Paul, thanks again for joining us. To get started, if we look back at the past couple of years and some of the changes in the F&C portfolio, I mean, they're quite significant. So you've cut back massively, I think entirely on small caps, increased exposure to US value, cut back on US growth. So can you talk a bit about those changes and the thinking behind them?
Yeah, of course. Good afternoon, David, and thank you very much to everyone for joining. I am going to give a bit of context before I come on to answer that question specifically. I'm getting a little bit of feedback. I don't know if, David, you want to close your mic and whether it's coming from you or not. That might help. But I'll give a bit of context as to F&C, and then we'll get into the specific question about positioning and changes, and I'm sure we'll have a discussion about outlook and so on. But very briefly, F&C Investment Trust, as you said, David, is a global trust. We are the oldest investment trust in the world, launched in 1868. Very long history and heritage, and in fact, we joined the FTSE 100 last year. We've got substantial scale with net assets of around about £5 billion. And our purpose and approach is to deliver long-term growth in capital and income for shareholders. And we do that by investing in a diversified portfolio of both listed equity and private equity. And again, I'm sure we'll come on to some of this detail, but we adopt a diversified approach for several reasons. One, to reduce volatility and timing risks for underlying shareholders, to smooth the performance journey as far as is possible when investing in growth assets. Secondly, well, there's clearly been a move towards much more focus and concentration on portfolios, we want to include the winners, and diversification gives you a better chance of including those long-term winners from markets. We seek to spend risk efficiently. So when we look to construct a portfolio, we're looking to provide an attractive return profile with attractive risk attributes as well, and to focus on risk where it's rewarded. So the optimal approach from our perspective is essentially to blend exposure across a range of concentrated mandates. And coming on to what the portfolio actually looks like and some of the changes that we've made in recent years, this gives you a sense of a snapshot of the portfolio from a high-level perspective as it stood at the end of last year. And I'll draw a few points from this slide. There is a lot of information on it. But basically, exposure to listed equities, captured through regional strategies and global strategies, and also private equity exposure, which is about 12% or thereabouts of the portfolio as it stands today, and that's unlisted private equity exposure. We blend our portfolio exposure across a range of different strategies, as I said, using resources from within Columbia Threadneedle, who are my employer, and from across the markets. In the case of the US, we have outsourced management of US growth and value to historically T. Rowe Price and Barrow Hanley respectively. And you can see the percentage allocated to each of these mandates, the number of holdings, and active share, which can be viewed as a kind of measure of risk on those underlying portfolios. So again, to repeat the point, focused portfolios, so that US value portfolio, which is was about 20% of our overall exposure at the end of the year, 44 holdings, so concentrated and focused on a cheaper segment of the market within the US, and that's blended, as I said, with different exposure again, and I'll come on to discuss this to smooth the performance journey for shareholders through time. But specifically on this point about changes, this slide shows some of the changes that we've made in the last few years, and as you said, David, they have been really quite substantial. So you can see the year-end exposure at the end of 2020, obviously when we were in the depths of the pandemic, end of 2021, and then the end of 2022, and very substantial reduction in terms of growth stocks. So highly valued companies with profits further out in the future, high growth rates in terms of expected growth and profitability, but further out in the future than value companies, which are cheaper, higher yielding typically as well. So reduction in T. Rowe Price, which running our US growth portfolio, rise in Barrow Hanley. The scale of that move was about $800 million when we include value stocks from elsewhere. So a really substantial move out of growth into value. We cut emerging markets, as you can see, cut that during the pandemic, reduced small caps down to 0 last year, raised global income, those higher yielding stocks, and also raised exposure to private equity. In a nutshell, there's many aspects to those numerous decisions that I've outlined. But if I reflect on where we were in 2020, in the earlier part of the pandemic, we started cutting exposure to growth stocks second half of 2020, raising value and income. Why? Essentially, what we viewed as excessive valuations in the growth segment of the market. So people had extrapolated some of those shorter term trends that had benefited stocks in lockdown, growth stocks in lockdown, into a longer term perspective, pushed up valuations to unrealistic levels. And we also had a view that the fundamental backdrop was going to change, i.e. we saw signs that inflation was going to be rising on a look-forward basis, interest rates were going to be rising, and historically that has led to a less positive environment for growth stocks, better environment for value stocks, and that's one of the key reasons that we made those changes. So valuations and change in fundamentals. Two other points to make, just very briefly, in terms of other changes we made, not evident from this slide here. Firstly, last year in the first quarter, we reduced gearing quite significantly, actually. We took out a lot of long-dated debt in 2021 and 2022. We didn't put that money we raised to work in the market. We actually sat on cash and still have quite a high level of cash in the portfolio. So we cut gearing because we were somewhat concerned about the outlook for equity markets. And we reduced sterling exposure from what had been around £300 million of a long sterling position down to about £20 million by the end of last year. So reduced that long position on sterling. Both those moves were somewhat fortuitous in terms of timing.
Okay, well, all very interesting. I mean, one of the changes that you can see here on the right-hand side of the slide is an increase in your exposure to private equity. I think if you look at discussions, particularly in the last 6 months or so, about some questions basically on valuations there, I think that might surprise some of the people watching. So can you talk about those changes? Sure.
Well, the first thing to say is, we are a closed-ended investment trust, and therefore we can take illiquidity and take that long-term perspective. And our private equity exposure is very largely unlisted, long-term private equity holdings rather than listed private equity. And obviously there are trusts that do that as well. We've got a couple of holdings in that space, but it's predominantly unlisted exposure. We have got a very long history of investment in private equity. We've had good experience in that area in general terms, in the sense that we've generally delivered a superior return from that private equity exposure as compared to public market equivalents over a long time frame. As is the case with elsewhere in the portfolio, our exposure in terms of that private equity component is diversified. We think there's good opportunity for differentiated exposure against what you can get in listed markets. And our recent commitments, and you can see obviously rising commitments in the last few years, part of that is because listed markets gone up and the proportion in private equity, listed markets gone down, and therefore the proportion in private equity rose slightly. But we have been making more commitments, and that's been predominantly in what we term mid-market opportunities of management buyouts. They tend to be relatively attractively valued. So we've not been putting lots of capital into the area which I think is perhaps most at risk and has certainly been most in focus, which is essentially later stage, highly valued disruptive tech. We've got very limited exposure to that area. But we have made about $360 million worth of commitments in recent years, made commitments to early stage venture and growth exposure, hard to access, leading VC and growth managers. But those investments have got a long time horizon, certainly more than a decade. It's very, very early days for that exposure. But going back to the question, we've had good experience in terms of private equity. There is a bit of a lag in terms of the pricing of underlying exposure, but we don't think we're particularly exposed to some of those trends which you alluded to, which I think really have hit disruptive tech in the later stage particularly hard.
Great. Okay. Well, I mean, the topic of this chat was supposed to be growth and value, and is what to do really in that sphere of things. I mean, the changes you've made suggests to me that things are actually more dynamic than perhaps discussions of that subject allow for, and that perhaps in some periods it might be best to be a growth investor, and in other periods it might be better to be a value investor. So do you think that's the case, and is that sort of why you've made the changes you have?
Yeah, so I think it's a really, really good point. And there's often a tendency to think of investments as in other areas of life in binary terms, all or nothing. I think my point would be there's more than one way to win in equity markets and investment in general. And different approaches will have varying levels of success through time. So what I'm showing you here is the S&P 500, which is clearly a bellwether US equity index. It's basically the broad market in the US, and that's the grey line. And I've got the ARK Innovation ETF. Now, this is a product launched by a firm that was set up in 2014. So I've not cherry-picked the start date here, by Cathie Wood. One of the most prominent growth investors and high-profile growth investors, at least in the retail space in the US in recent years. And there's a real focus on disruptive tech here, big bets in terms of position sizes. Cathie is extremely vocal, huge presence, as I said, in the retail audience. So I think it's quite an interesting example of that really growth-oriented retail product. Started from nothing in terms of assets in October 2014. That firm, not this product, but that firm peaked at $50 billion in terms of assets and is now down, I think, about the 14 or high teens in terms of AUM. However, the point, and I made this earlier on, is that you can see performance was broadly in line with the market up until 2017, and then really started taking off. And then the pandemic exploded, and subsequently it's come back very sharply. So your experience as a growth investor and investing in this kind of product, and there are numerous other products like this out in the market clearly that performed maybe not quite as in such a volatile manner, but in a similar fashion, your performance experience is very much driven by your point of entry. So you're going to have quite a different view on the success or otherwise of this kind of strategy if you'd invested at the beginning in 2014 as compared to if you'd invested in the mid part of 2020 or the late part of 2020. So style, performance, growth, value, quality, income, they all have merit undoubtedly from a longer term perspective, but performance is volatile and it's not easy, clearly, but if one can form a view about when and why these styles are likely to perform best and less well, then obviously that'll be additive. And I wouldn't go as far as to say that we timed things perfectly, but certainly we I think managed to navigate some of that growth value dispersion relatively well in the last few years, and certainly avoided the worst of the sell-off, which obviously affected many investors in 2022.
Yeah, so I think something you've sort of alluded to there is the potential that a manager or investor can end up chasing returns. You go after one style when it's done well, and then you see another one, so you go after that, and then you end up just kind of, it's almost like day trading. You end up just losing money basically. So how do you manage that risk if we accept that markets are dynamic and things change over time?
Again, I think it's a really good question, not easy, but I think the fundamental point I would make is one has to follow an established process, and process provides an anchor during periods of volatility. Clearly, volatility and performance works both ways, whereby there can be a fear of missing out. You can, clearly when momentum is very strong, one can have a strong temptation to latch on to current performance patterns, and conversely, when things are really bad in terms of an underlying style or market performance, then the temptation will be essentially to capitulate at what would be the worst time. And again, the experience during the pandemic, so both sides of that, where markets performed extremely poorly, clearly in the early part of 2020, before subsequently staging a very strong rebound. So essentially, process, I think, has to provide an anchor in terms of decision making and managing that exposure through time. I think that, to repeat the point, it is important to diversify across a range of different styles so that you don't miss out on having exposure to strongly performing areas, and try to tilt exposure to in an opportunistic basis through time. But when you think about process, the way that I think about making those kind of decisions is essentially based upon three primary decision points. There's a fundamental component, and that is a strategic perspective as to where we are in the cycle, in terms of the economic cycle, where we are in terms of growth, inflation, interest rates, as well as more micro considerations from an industry positioning perspective and so on. As elements are going to influence performance of styles and also influence the earnings outcome of particular segments of the market, depending upon what the broad backdrop looks like. So there's a fundamental pillar. Secondly, valuations are really important as well. What is reasonable to be priced in, given that fundamental perspective? So what is in the price based upon one's view of the broad backdrop? And then the third point is behavioral factors. So that's how people are positioned and broad sentiment. So again, think of growth stocks in the pandemic. There was undoubtedly fundamental improvement. Many companies benefited from during lockdown, but for many companies it was temporary, not permanent. So Peloton would be one example of that, arguably. But we could see rising inflation, we could see rising interest rates, partly as a function of what government policy meant in terms of future economic outturns. And that's bad news, typically, for long duration growth stocks, with much of their potential profits further out in the future. Valuations, again, I made this point already, but valuations became completely overblown as people extrapolated that short term into the longer term. So there's shades of a new paradigm being priced in, and one has to be somewhat cautious when you're told that this time is different, in terms of valuation of some of these stocks. And then in terms of that third point, the behavioral components, there was speculative excess, over optimism, and hubris, which I think was certainly, with the benefit of hindsight, was obvious in some segments of the market. And as you can see from this chart here, frankly, a lot of that excess has been unwound, right? So a lot of that excess optimism, that excess valuation has diminished. So again, with the benefit of hindsight, one can look back at that period and say, well, the fundamentals had improved, but not to the extent that was priced in through valuations, and sentiment had become somewhat overblown. So having a process which focuses on those elements, I think, can help you to guide, during those periods, particularly of extremes, that we see on both upside in markets and downside.
Okay, well, to move on to a slightly different topic, and it's again something you've touched on quite a lot in your answers so far. One of the big selling points of the trust is how the benefits that diversification confer on investors and shareholders. But at the same time, I think recently I saw you gave a presentation where you talked about effectively how quite a small number of companies are those that actually drive returns. And if we again assume that there may be one style in fashion as opposed to another, that sort of makes it seem as though actually diversification might not be beneficial. It's better to try and target these winners as opposed to just having a huge number of companies in your portfolio. So can you talk through the logic of diversification? How does it work for you and for your investors?
Yeah, sure. I think one of the most interesting pieces of academic research which we've seen in recent years is this work from Bessembinder, which has been closely followed by a number of investors and fund manager houses, and some of the key results that he I wouldn't say he goes first to say discovered, but what he outlined are there, which is essentially, in the long run, there's only a very small number of stocks that actually account for the vast majority of returns in equity markets. And this is about skewness in statistical terms. A small number of stocks are driving returns in the long run. And the reality is that if one particular cohort of stocks or one particular style is dominant, then it can be hard to keep pace with those returns unless you have a very concentrated portfolio which is correctly positioned in those stocks. Now, many investors, I think, somewhat forget that the winning stocks are not necessarily constant through time, and the characteristics of those winning stocks are not necessarily constant through time. So you can think about those small number of exceptional companies that deliver all the returns as like needles in a haystack. And to draw again two extreme approaches, one approach, if you're looking for a needle or needles in a haystack, is you have a high conviction approach, and you spend all your time searching for those needles. That is somewhat akin to the highly concentrated manager who says, trust me, I can find those needles and I can focus all of my resources on those very small number of companies that will provide outsized returns over the long run. The other kind of extreme approach is simply to buy the haystack. And that's like an index fund. You say, look, I'm not sure I can find the needles, but if I buy the haystack, I buy the index, then I know I'm going to have exposure, right? So that's the approach of the index fund. I think, again, as with other areas in life, the truth or the optimal approach arguably lies somewhere in between. So our approach is, rather than having essentially one head in the haystack looking for the needles, we focus on different parts of the market and different styles, and have a range of different skilled managers searching for the nuggets, the needles or the diamonds, however you want to, well, you know, however you want to define it, in a particular segment of the market. So this increases the chance of beating the market, essentially by diversifying and having a range of different approaches, looking in different segments, because we know, frankly, again, from academic evidence and from observation, that returns, you know, to one particular style or way of investing are not constant through time. And therefore, growth will not always be a winning strategy. Value will not always be a winning strategy. Quality will not always be a winning strategy. If we diversify across those types of investing and do it in a concentrated way with individual managers, then blending exposure across those different styles will give rise to a smoother performance outcome and a better performance overall for clients, less volatile for sure.
Okay, well, I think another risk that people associate potentially with diversification. This is something that I think Mark Spitznagel wrote about last year or the year before in his book, Investing for Storms or something like that. Is basically that you get a kind of diversification where you don't perform particularly well in good markets, and then you're not particularly protected in bad markets. So how do you ensure that those things do happen, if that makes sense? So you do outperform when you should, and also you're not underperforming when markets are bad.
Sure. So like, I think it's not easy, you know, to deliver excess returns against the market. I think there's another fallacy that we should just touch on briefly, which is, you know, more concentration is better. More concentration will give rise to a higher probability of excess return. You know, again, there is some academic debate on this point. I think all we can conclude is that if you've got a more concentrated portfolio, more focused portfolio, you are more likely to provide returns that are different than that of the market, rather than necessarily out or underperform. In fact, you know, I think going back to that Bessenbinder study, one of the points that he made was, if you have a highly concentrated portfolio, you are less likely to have exposure to those winning stocks, and therefore, on average, you're probably going to be worse off. But I think that you do make a very good point with respect to diversification, which is there comes a point where too much diversification means you are essentially the market, right? And that isn't what we're looking to deliver. Now, this is a somewhat stylized chart, but it illustrates the point whereby, you know, spending risk efficiently, in my mind, is about blending diversified strategies. So again, I'll take the value growth example. We've got a risk contribution from our value manager, which is Barrow Hanley. We've got a risk contribution from T. Rowe Price on the left-hand side there, and various other components. If you add up those risk contributions kind of on a standalone basis, which is what the top of that blue bar on the right-hand side there is, you'll find that the risk is much higher than actually what you observe in the portfolio. So by blending different components, each of which have a different way of investing, you can add returns while reducing risk. And that is the whole principle of diversification, and it still works in equity markets today. But I think your point is absolutely right and fair. There does come a point where, frankly, you're just better off buying the market.
Yeah, definitely. So, I mean, the last question that I have for you is around, again, it goes, I think you're going to bring it up on the slide at some point, but it was basically you were looking at what had been the major drivers in markets of outperformance, and there's quite a noticeable gap if you look prior to the financial crisis and afterwards. So obviously growth investing has done extremely well. since the financial crisis. And I think for many people, that is basically just because interest rates were very low. Interest rates now are not definitely not as low as they were and may continue to rise. So do you think we'll see a sort of switch in dynamics again moving forwards, as we did after the financial crisis?
Yeah, I do. And again, there's quite a lot of information in this slide, but I think you made the point. Essentially, if you take a very long-term perspective, look back many decades, you can see that famous French factors or different styles, growth, value, quality, so on. There's a general expectation of a positive return from investing in a certain type of way. And actually, just as an aside, most managers, a very large chunk of their performance will come from the way that they invest, which leads them to the type of companies that they have exposure to, rather than the names per se. And even, it's a bit controversial, I know, but even Warren Buffett had his quote-unquote alpha decomposed by a firm called AQR, who did quite an interesting piece of research about how Buffett had actually generated those phenomenal returns, and they could essentially explain a lot of it due to factor exposure and his access to cheap leverage. So the point you made, however, is that over the last decade, or certainly since the global financial crisis, monetary largesse, low interest rates, high levels of liquidity have helped to drive equity markets overall. And I think have helped to drive the differential performance up until a year or so ago between growth and value. So there's definitely, I think, been a strong tailwind which has benefited growth stocks to the detriment of value up until recently. I think I would make one other point though from a fundamental perspective, and again this is a huge discussion in of itself. We can see in almost every segment of the US economy and more widely that industries are becoming less concentrated. So arguably there's less concentration, and that's one reason why there's less competition. There's more kind of oligopolistic outcomes, which means that margins have been bid up in the corporate sector, which means that the winners have become bigger and bigger. And you can see that in markets as well, and particularly in disruptive tech. So there has been a fundamental driver behind this, but I think that interest rates, inflation, liquidity have also played a role. And I think if one looks forward, it's certainly a different environment today than where we were several years ago, given rates of inflation, given where we are in terms of interest rates. And markets have obviously adjusted to some extent for that already. But if you look at from a valuation perspective, and there's different ways of measuring this, so I think you'll generally reach the same kind of conclusion. What this looks at is essentially a valuation gap between growth and value stocks. And what it shows is that growth stocks typically trade at a premium, but the premium that you're still paying for growth stocks is still quite large compared to history as against value. And if we're in an environment of higher interest rates, higher inflation on a structural basis, then that would argue, I think, that gap erodes through time. I do think, again, without hopefully contradicting myself, that as we move through this year, inflation has peaked. I think interest rates are going higher, but we will get closer to a peak in interest rates. I think we're going to see a growth slowdown, and declining inflation expectations, some moderation in interest rate expectations, and a lower growth outlook actually is not a great environment for value typically. So I think it's much more nuanced this year than it was last year, but that value gap between growth and value stocks is still evident. I'll maybe make just a couple of points before I wrap up and we move on to broader Q&A. But I just want to point out very briefly where we got to in performance terms. This is end of 2022, and I'll show you on the right hand side there the performance in quartile terms. against peers from a NAV and a shareholder return perspective. So it's been one thing we seek to deliver is consistency. We are diversified, we're blending styles, and we should deliver a consistent outcome, and that is what has been achieved. We're the best performing in shareholder return terms, actually. Global Trust last year, we declined by 0.9% total return for shareholders in 2022. And the left-hand side shows the performance since I took over the trust in mid-2014. So that's probably enough of a plug. I'll pass back to you, David, and I'm very happy to take any questions.
Yeah, great. So we've got quite a few, so I'll try and get through as many as possible. Apologies if we don't get to yours. So to get started, just quite a simple one. Someone else, can you elaborate more on how you benefit from exposure to both public and private equities? How do you think about your weighting to PE in the portfolio?
Yeah. So it's a very good question. Sorry, David, I think I'm good. Thank you.
Sorry.
Yeah, so again, we've got about 12% or thereabouts of the portfolio in private equity. Even though we're closed-ended, I think one has to be mindful about how much a product like F&C has in private markets. So essentially, we've set a cap, the board set a cap of up to 20% in private markets. However, we aim to operate in a range of 5 to 15%. So we're slightly above that midpoint of 10% right now. How do we get to that number? Well, it's an art, not science, but what I would say is it's going to be large enough so that it makes a meaningful contribution to investor or shareholder returns, but not too large as to be disruptive. Because again, even though we're closed-ended, we do employ gearing, albeit very, very low at the present time, and that can clearly exacerbate returns in down markets. And we also have a policy of buying back shares when we're trading at a sizable discount, and that can shrink obviously the number of shares in issue, and all else being equal, push up the weighting in private equity. So it's going to be a substantial enough portion to make a difference, but not too large as to be disruptive. And as I said, to repeat the point, 5 to 15% is essentially where we're targeting in terms of that exposure, and we're in that range right now.
Okay, so this is slightly similar question, which is how do you have to rebalance the portfolio to maintain your allocations?
So the way I think about this is there's a hierarchy of objectives, which is essentially the overriding objective is long-term growth in capital and income. How do we achieve that? We invest in growth assets. What growth assets? We invest in equities and private equity because we're closed-ended. The rebalancing question is less about rebalancing, I would say, and more about adapting the portfolio to be consistent with my view of the world, where I think we're going to get best returns from, while achieving a diversified set of exposures. So I showed you in the presentation, at the end of 2020, 2021, 2022, the weightings in those respective areas. The movements through time are not a function of rebalancing per se, which implies a somewhat mechanistic approach. It's more about thinking how much of the portfolio do we actually want to have in that area. And then on this risk budgeting point, when I showed you that waterfall diagram of building up exposure through time, then compression of risk, how much risk do I want to spend in a particular segment of the market, like the US, for example, or emerging markets, and how much do I want to spend on a particular style? So again, rather like the previous question, it's an art, in my view, not a science. We do have a benchmark, which is the FTSE All World, and that's one metric against which our performance and our exposure can be assessed.
Okay, so there's another question on private equity, which is, do you think it would be worthwhile investing in listed trusts, which are all on quite wide discounts, rather than committing to new funds?
That's a really excellent question, one that has been exercising my mind in recent months. I have observed, like the listeners and many people across the market, the listed private equity trusts are trading on very large discounts. Many listeners probably follow this more closely than me, but some of those big ones like Harbour West, Pantheon, were trading up to 50% or thereabouts. Discount to NAV. Now, there was a question and is a question, can you trust in the asset value? And, is some of that discount illusory? You've also got to normalise for what is a normal discount on those trusts. So it's much bigger than normal, but they do normally trade in quite a big discount. The short answer to the question is I'd be open-minded on that. With a £5 billion trust, however, like F&C, it'd be quite difficult for us to gain really substantial exposure to opportunities like that at a screen price of a 40 or 50% discount. Because if we went in and started buying tens or hundreds of millions of pounds worth of that exposure, then naturally that's going to compress the price. But I do think it's a very interesting question. I think, just to draw a couple of additional points which I do think are interesting, I do think there is going to be certain sellers of private assets in the UK, driven partly by the LDI debacle, which many of you will have heard about last year. Pension schemes are in much better solvency position today, given rising interest rates, and that is actually leading to quite attractive deals from a secondary perspective, as well as in terms of listed private equity as well. So I am open-minded about that, but it'd be quite difficult for us to gain substantial enough exposure. I'm not able to give investment advice, clearly, but I do think it's quite interesting just how large those discounts are. The slight challenge, and I know I'm going on quite at length on this point, slight challenge some of those trusts have is in a world where people are very cost conscious, they are somewhat disadvantaged, that natural buyers are having to report on the cost of those trusts, like wealth managers, for example. So it's quite hard for what might be natural buyers to actually have substantial position in some of those trusts now. So it might mean there is value, but it's perhaps not as much as one thinks, because there won't be the natural demand, unfortunately, to narrow discounts.
Okay, well, you've got a couple more. Let's see. Do you have you, I suppose, changed your mind at all about small caps? I think you basically cut down massively on there, just because so far this year they seem to be performing quite well. Or
Yeah,
they're still thinking the same.
Yeah, so again, the trust had held small caps for a very, very long time, different ways, US small caps, then global small caps. I mean, small caps have obviously picked up in performance terms. They're trading on, what look like quite attractive valuations. I take the view that if we're heading into, well, firstly, last year I thought the cyclical environment for small caps was pretty tough, and I had been reducing exposure to that area. It got to a size in the portfolio of kind of 4% or thereabouts, and I thought, well, if I cut it any further, it's just be as well getting rid of it completely, which is where we ended up. I also, to this point on diversification, wanted to bring a bit more focus into the portfolio. So rather than having lots and lots of small exposure in that segment, I thought we would just gain a bit more focus at the overall portfolio level by getting rid of small caps. I think the other issue that small caps face is they tend to have higher levels of leverage than large cap stocks, and that might be somewhat problematic. And I do think the impact of rising interest rates is going to take a bit of time to wash through. And also small cap performance, while there is an observed premium in small caps. A lot of that is actually explained by industry and style exposure rather than being small per se. And the performance of small caps is pretty lumpy, actually, through time. Small cap value, I think, reached a pretty interesting point, but I'm not intending to re-engage with small caps. Doesn't mean I don't think there's an opportunity there. I just think there's better opportunities for us as a trust to deploy capital while retaining that focus, which is important to this point in diversification.
Okay, so I'm conscious that we're almost out of time. Are you happy to do a couple more questions, or have you?
Of course, yes, absolutely.
Okay, so I'll just ask you these final two at the same time. So one is, has income generation for the trust become easier after many firms shored up their balance sheets during the pandemic, or like 2020, 21? I'm assuming they're referring to pandemic. And then the other one is whether you have any view on China opportunities in China, and maybe if you can say something about political risk versus economics, if you have a view.
Yeah, okay. So, yeah, I think the short answer to the first question is yes, income generation has become easier. And, we did a lot of modeling actually in the early part of the pandemic as to what recovery looks like in income. Typically, when you get through a period of downward adjustment in earnings and revenues, what that looks like. And we report our annual results actually later this week on Thursday. So I'm a little bit constrained in terms of what I can say in terms of what those annual results will show. But what we found historically and has been experienced recently is that recovery in our income was very strong in 2021. We expected it would be strong in 2022. Our half-year results showed that was the case. So it has become easier to generate income. And again, just a bit of a plug later this week, I can give a bit more detail about what that actually means. But the short answer is yes. That said, clearly equity prices have adjusted. So our overall yield, we're not a high yielding stock. We've got a great track record, but we're looking to balance income and capital. And I think, again, that's really important. Within reason, I can give you whatever income you want. It might be to the detriment of capital, right? So balancing those income and capital needs, from my perspective, is a critical consideration. And again, reflecting on what I said earlier on, we have a specific income strategy on the portfolio. So rather than getting managers to target a particular level of yield, we only do that on one part of the portfolio, and that part of the portfolio has performed very well against income comparators in a long-term perspective. Briefly on China, look, China had performed terribly, then performed fantastically well, obviously driven in part by the reopening story there, and has obviously succumbed a little bit in recent weeks to a bit of profit taking, but the market, depending upon what metric you use, had been up like 50% or thereabouts from the low. It's quite interesting that the point where there was a real chorus of people proclaiming that China was uninvestable was pretty much the low in the market last year, give or take, and it subsequently staged a very strong recovery. We do think that there are opportunities in China. We do have exposure to China, but it's kind of caveat emptor. One has to be very mindful, clearly, to the point in the question, of political risks. And that is going to, frankly, become a bigger issue going forward as China takes a larger share of the overall world market. And we look at this very much from a micro perspective, try to manage that as best we can. Some of those big disruptive tech names where we've got limited exposure, I have to say, in China, have obviously been most at risk in terms of state intervention. But it is a generalized point there. Very, very difficult to model. And I think is going to be an ongoing challenge, clearly, for investors going forward. And that warrants a higher premium on Chinese assets, and therefore a somewhat lower valuation. I would argue someone needs to kind of normalise for that political risk. So not a direct answer to the question, but perhaps just some thoughts there.
No, I think that did the job. So that's all we've got time for. I appreciate. I'm sorry if we didn't get to your question, but there's a lot of questions and not a huge amount of time. So Paul, thanks very much for joining us. That was all. It was all very interesting. And for everyone watching, as I said at the beginning, we're doing this throughout March every day at the same time. So do tune in for some of these other conversations as well. So thanks again, Paul, and hopefully we can chat again soon.
Thank you very much. Thanks to all your listeners. Thank you.